The broadcast is now starting. All attendees are in listen-only mode.
Face is a place where traders come to become an ace. Anyone become an ace from hanging out with Blake and the crew? Feel you're there? A flying ace? Okay. So I want to welcome our viewers from investing.com. You guys are good and want to stick around. Special guest Peter Bookvar, renowned economist, analyst, contributor on CNBC. It's going to be interesting to see what Peter's thinking after the big down month in October. And there's a Fed meeting today. And I know Peter is a dollar bear, and we're starting to come off in the dollar. So be here at the top of the hour for Peter Bookvar. You could find him on Twitter at pbookvar. So let's take a quick look at the market. I kind of have a theme. One more wave, one more wave. Still my contention that before we take out this high in US dollar yen, we're in a rising wedge. I'm early from yesterday and still think looking for add-ons, but I'm going to wait for some more confirmation back under 1340. I have enough in here. It's a wedge. If it breaks down, I know it's a big target. But, I still think it's possible that, we even get a move down to 110. But we'll take it a step at a time. And, this wedge would come in around 1160. But if we start taking out yesterday's lows, 113, this 1229 is where I'd book 50% if short. Then pull your stops to BE. And you have no heat, you have no stress, and you'll stay healthy and have a longer term trading career. Okay. So how does that fit into the jigsaw puzzle? Still my contention that the dollar has peaked short term, not long term. This is what I mean by one more. So why can't we have one more break towards 94? That would be a measured move. Some people might start calling this a head and shoulders with a neckline right here at 5.5. 5.5 has been a pivot, and the measured move would take you down to 94 or so. And with that being said, if the yen does turn down, we should get one more pop in the metals. So looking at gold down here and silver. Gold holding up a little better today, only down 0.1%. This looks corrective after the big pop we had when the dollar peaked last week. And there are a lot of bears. So I think they punish them one more time. And we head up towards this line before we fail. While the dollar's going lower, and that'd be about 1252. So yen down one more time, gold up one more time, and then I think the position short in gold could develop here because I still am looking for this. And a lot of people, once we're over 1240, and I can understand why, are going to consider this a big breakout. But it could be a breakout fake out. Because even though I think that I'm not with some people that think the dollar has peaked, I think it's more of positioning and shaking out all the bulls, just like we shook out all the bears. And with that being said, also the stock indexes, I don't have the courage to step in and short it yet. I'm very interested in this 28-29 level. And I believe Steve Anton, when he was here the other day, had one of his proprietary bands. So, people ask me why I interview people. It's because I also get some pretty good insights on levels. So I'm just a selfish bastard interviewing these people so that my trading could be better. All you guys thought I was a nice guy, a humanitarian, but it's all self-interest, right? Okay, so we'll see what happens here at 61.8. Obviously, the leadership is the Dow. If you look at the moving average action, the Dow is above them both, right? I mean, Dow looks like new highs are, could be possible, uh, unless we're going to stall out right here, and that might happen. But I just want to show you the relative strength rank. So Dow number 1, S&P number 2, and the weak sister that, we haven't even achieved 61.8 in NAS 100. So preferred short for me, if you have the courage, it's going to be looking for shorts in the NASDAQ. And even if this is the low in all the indexes, within here somewhere, we should get at least some kind of pullback, maybe up here, and then put in, here's a left shoulder, maybe get a right shoulder. So I think there should be some type of correction between now and Thanksgiving, because there's an old Wall Street saying and an adage that the bears feast on Thanksgiving, a few weeks away, and the bulls feast on Christmas. So we'll see how that all develops. I want to remind people that it's very important where you trade. And it's also important that you get paid by your broker, especially if you're an active scalper with a reimbursement that could either pay for your subscription here at ForexAnalytix, or you can get a rebate check. Yesterday, someone said he got his first rebate check. He loved it. So it's almost like you're being paid to do what you love. You can go to Forest Park. They're a broker of brokers. They have relationships with so many brokers. For you to do your own due diligence would take you quite some time. So Trent and Justin are who you contact, and all of their contact information is here for the reimbursement program. Also, since I confessed about my self-interest and how I really am, I want everyone hearing my voice today to sign up for at least a free trial. Okay, so time to sign up for a free trial at ForexAnalytix. You risk $1. And after that, in 10 days, you're going to know that you found a great place to trade. You found a great team to work with. And that's my pitch. So I'm ordering everyone to become a subscriber that is listening to me. Give me a Y if you're going to sign up today. Okay, there's one. Come on. Oh, you're already a subscriber? Okay. Thank you for supporting our efforts. We lay it all out there on the floor. We're up all night for the midterms, pushing out 30 alerts, rocking in the private chat room. So I'm going to pass it over to Blake now.
Hey, Coach, how you doing?
All right, buddy. How about you?
Hey,
how's it going?
Good. You know, before I get started, I actually have some housekeeping. I want to grab the screen really quick. Why am I not on the? Oh, there I am. Never mind. I was like, where am I?
I forgot to tell you, Stelios fired you.
Oh, I'm fired.
You're bumped. He wants to be CEO.
Okay, but before I get fired, so I was just returning an email from a very good friend of mine, and his interview is at the end of the month. And I want to clarify with you really quick, because, you know, I'm going to do this on a public forum just because it's such a big interview. My interview for Ronnie Schlapfer is going to be the 29th or 30th. I thought it was the 30th, but for some reason the 29th jumped out at me. Do you have your schedule in front of you?
I'm looking.
And I'm going to tell you guys a little bit about Ronnie. And I'm telling you now because this is such a big interview for me. I'm going to be hosting. Coach will be there, but he's a very good friend of mine.
I have to be quiet.
You do have to be quiet. It's going to be tough, but I'm gonna confirm the date with Dale here
I don't have it.
momentarily.
I don't have it written down, Blake, but I know it's one of the Fridays in November, the 16th.
So
The 23rd is the day after Thanksgiving. I don't think it would
yeah,
be that day.
no, I think we were talking November 30th. So I just want to confirm.
Okay.
He said either or.
Okay.
Yeah, his name's Ronnie Schlapper. Now, let me tell you a little bit about Ronnie. For those of you that don't know who this person is, there's an old video. Let me see if I can find it really quick. The $1 billion day. Okay, so there's an old video here, and this is probably a staple of any FX trader. If you haven't seen this video, it's 1985 BBC.
Wow.
It's playing right now, but I can hear it, but I'm gonna actually put it in the chat box.
Yeah.
So you can see this is a video that was done by the BBC. You can see it's in 1985. It's called the $1 billion break, or $1 billion day, rather.
Does he look any different now, Blake?
Oh yeah, yes. But this is him right here,
35 years ago.
Yeah. So this is Ronnie, and this gentleman is a very, very good friend of mine. He's one of the people being interviewed. He's Swiss. He's been he used to manage the it's not Barclays. He managed one of the big banks in Japan, their trading desks for many years. Then he moved to Manhattan, and him and his partner managed Switzerland's education pension fund, I believe. 90% sure that's what it is. And anyway, this is Ronnie, and it's a great video. It's called the $1 billion day, and you can see, it's so funny. You can see these you can see all these old BMWs and old trading floors, and it's about these three traders that are trading basically against each other. Some yen trades, or was it cable trades?
That was around the same time frame as Wall Street was made.
Yes. Yeah. And this is really in the heyday of
and I was young.
Yeah. Well, Ronnie is, for those of you that don't know who he is, he's a really good friend of mine. Probably one of the most well-versed traders that I've ever met. And I've met, I believe it or not, I know traders that are probably even more knowledgeable than him, but he is I don't know. I'd actually rank him up there with the top 1 to 2 traders that I've ever met. And he is an amazing individual. And I see him as more of a mentor to myself. And he has been kind enough at the end of this month to do a one-on-one interview with me, and on this forum, where you're listening right now. And that Friday, which will be the 30th, is going to be an amazing event for all of you. So make sure you mark your calendars and be here live. I'm going to, he's probably the best person ever to talk to you about strategy and risk management, and tell you some really, really amazing stories about what he's seen. He's seen thousands and upon thousands of traders succeed and fail, and he's seen it all. I mean, for somebody who's been in the business for 40 years, and has managed the type of monies he's managed, you guys cannot miss this interview. And like I said, he's a great friend of mine. We talk probably on the phone at least once, if not twice a day sometimes. And sometimes he's traveling, so it might be a couple of times a week, but
What's the most important thing you learned from Ronnie? Like,
cut your losses. Don't take big losses. But I mean, people you hear it. You hear it all the time. You hear people say, you know, cut your losses short, let your winners run. There is no, you guys understand when you're trading the markets, you have a certain amount of money. And if that money disappears, you are not trading anymore. That's right. I mean, period, end of story. I mean, there's no if and or buts about it. So if there's one thing that, he'll drill into your, in your psyche is, don't take big losses. And he's a master of knowing he's wrong and just cutting it. Or even if he may think he's still right, he'll still cut his loss and he'll revisit that same idea at a later point because his timing may have been off. But this is truly a man who is succeeded on so many levels. And I've been to his homes. I've hung out with him in the Hamptons. I've been in his cars. He's a guy that has made it, and in a big way too. So you guys cannot miss this interview. And it's going to be November 30th. So just letting you guys and gals know, it's going to be amazing. And I'm so happy to bring you this interview. All right. And just so you know, he doesn't have a social media presence. He's not a guy that you're going to be finding on Twitter, following around. He, unless you're on his email chains, or you got his phone number, you're just not going to be able to, really discuss anything with him. So I'm glad that I'm able to bring him to you all. So I hope you guys
this is the point
enjoy.
That you put his phone number in the chat box, right?
Yeah, and if you want to call him, here's his phone number so you can text him anytime you want.
Blake, was he written about by did Schwager interview him?
No. He's not that kind of guy. He's not the kind of guy that, he did that BBC interview, and it's funny. I've actually been at his family's house during the holidays, and we've played that video in front of the family. It's fun, but he doesn't like it. He's not a guy that wants to be in the limelight. He's not a guy that's going to be, you're not going to catch him on CNBC. You're not going to catch him, talking about himself. He's extremely modest.
I can relate to that.
When you meet him, he doesn't, you would never know he is who he is, if you just met him like in a bar, and just chatted with him, you'd think, oh man, this guy's just like the nicest guy in the world, but he's not. He's an amazing person. And like I said, I'm happy that I can bring this to you guys, this interview, because he's such a close friend, because he's such an amazing trader, and he's got so much to tell from an education knowledge standpoint, that I think all of you guys are going to really benefit from this, because he's made it, and he's made it in a big way.
Trade?
Oh God, yeah. God, you can't.
Right.
You can't.
In his blood, yeah.
Oh God, yeah. He's always in the market. He's always got something going on.
Some guys walk away, like your buddy that went to the vineyards, and
Yeah, some people do. No, Ronnie's one of those people that he's always got something going on, and I throw him trade ideas all day long, and he a lot of times he's just like, yeah, it looks good, I'm getting long or getting short or whatever, and he's also a master of networking with some of the best minds in the business, and he pulls their ideas. So like he'll be talking to 50 different of the best minds in the world, and he'll pull different ideas from them and say, my buddy over here is telling me this, and then my other buddy over here is telling me that, and he's like, putting two and two together, and patching together some ideas. And when you've been in the business for 40 years and you've been at the level that he's at, he's not talking to some schmuck out of Phoenix, Arizona, trading from his home office, that would be me. He's talking to, heads of desks, trade desks, and people that are extremely significant from a flow standpoint. So just a really neat individual. And so I hope you guys really enjoy that. Anyway,
Sounds
okay,
great,
with that,
man.
it's going to be fun. It's going to be fun. And so with that being said, let's move along to the markets. Now we have the FOMC that's coming up today. Now, if you use ForexAnalytix, you knew that today that the euro dollar was testing this trend line. It says the euro dollar is testing an uptrend line at the 114.07 level, also the 88% retracement as well. Hopefully you weren't trying to get short as we were trading at 114.07. We've bounced since then from 114.07 all the way back to 114.30. We're probably going to find ourselves mid-range, maybe in the middle of today's range, but some mid-range capacity ahead of the FOMC today. There's a hold on really quick. Okay, just exiting something that I had. So the FOMC, we're not expecting anything dramatic from the FOMC. It's just a statement. It's not a meeting. So, and we're expected nothing's really changed, and so we're not expecting sentiment to shift much from the expectation standpoint. So where does that leave the euro or the dollar index? Frankly, I don't think there's going to be a whole lot of movement today, unless for some reason the market starts to shift away from a December hike from a probability standpoint. But it's pretty much baked in the cake that we're going to get. We're gonna not have a hike today, but in December we are going to get a hike, our fourth of the year. So the market's already expecting that. If we walk away from today's statement, because the statement shifted somewhat, and it seems like the expectations of a December rate hike are not fully, it's not a done deal, then the euro dollar could be very easily trading right back at 114. 80, 115. Also keep in mind that the euro dollar is struggling here as we're hitting the 38% retracement. I personally, and I tweeted this out yesterday, I think that we're in a bearish wedge. So meaning that we have constant lows, lower highs. I think the risk of a move back up towards 116 is still pretty great. And it's not necessarily because of the euro. I'm not looking at it as, oh, the euro is extremely bullish. I'm actually looking at it as the dollar's somewhat weak. And it's so I want you guys to understand that. I'm not looking at the euro going, oh my God, everything's fixed in Europe, I want to be long euros. I'm looking at it more as the euro dollar is trading at is trading around some support here. And if you look at the cable still looks extremely bullish. I know we're stalling at the 78% retracement, and I know that there's Brexit headlines and there's a lot of risk here, but we have a possible double bottom here. The pound's had a really, really nice move higher. The pound could still stage a rally, especially if we get into the next couple of weeks and it looks like a deal is going to get done. But you look at the Aussie is extremely bullish. We're out of this channel now. We're out of a down channel. And if you don't know, we put in a pattern in play. I did yesterday on the break of resistance. And that this was at 75 when it was there. I'm long the Aussie. I got long it last night. So if you're trying to buy it now, I issued that when we were about right here with the Aussie. We break above the 73.10, and this thing's going to start ripping. Now, if you don't think that can happen, well, just go take a look at the Kiwi. The Kiwi came out of a down channel, and now it is ripping. I think the Aussie could play easily play catch up with the Kiwi dollar, especially knowing that we have trade talks with China coming up, and if people start assuming that things are going to go well, that the Aussie could take off here too. Dollar Canadian is just dead money. It is dead right now. I'm frankly, I'm just looking for a move here. Just, give me a move, above 131.50 or below 130.50, and then I can figure out what the hell I want to do with this currency pair. But I'm not doing anything right now. I've actually tried to trade the dollar Canadian a couple of different times on the short side up here, and I've walked away pretty much flat the last 2-3 times I've traded the dollar Canadian at these levels, because as you see the Kiwi and the Aussie bounce, you would expect that the Canadian would have rolled over by now. It hasn't, and a lot of that might be with the new NAFTA agreement or the USMCA. It may come up contested, because of the Democratic House moving forward. So, the dollar Canadian may have some struggles here. I don't think anybody knows what to really do with the dollar Canadian until we have better information on what Congress is going to do with USMCA. So just when we thought we were past NAFTA, well, maybe we're not. One last thing I'm going to mention before I turn it over to Steve and Stelios and Coach is the dollar yen. Now, the dollar yen remember, we had a double bottom false breakdown, which has led to a breakout. Ultimate target for the dollar yen comes up at 114.20, which would be a double bottom target. Now, I know, Coach, you had been talking about an ascending wedge in the pair, but I wouldn't stand in front of the dollar yen. And I'm gonna tell you guys how I feel about the dollar yen right now. Coming from somebody who's tried to short it a couple of different times over the last couple of weeks, it is extremely resilient. And even when stocks sell off, it's not going down. So if stocks continue to rally, this thing is gonna pop above 114. Again, I know I've used the reference or the example of a beach ball underwater. It is just not going underwater. It's like you keep trying to push it. Eventually you get so tired that you let it go and it pops right out of the water, pops up. Same thing with the dollar yen. It is not going down. I actually tried shorting it this day on the election. I think I shorted it at 42. I closed it at like 37 or something, and then as soon as I got out, it like 15 seconds later, it dropped another 10 pips, and I was so frustrated. And I haven't touched it since then. But what I have observed is it is extremely resilient. It is not going down. The yen is really. You look at equities right now. You got the S&P that's down. 0.37%. You've got the NASDAQ that's down 0.5%. You've got the Dow that's down 0.2%. Dollar yen's up. It's up right now. It's up 20 pips. I mean, the thing, if stocks fill the gap today,
I think it's correlating more with yields right now, Blake. Yields, and yields are pushing near new highs.
Yeah, and you know what? And you are exactly right. Let's go 10-year. I have the yield. It's somewhere down here.
US 10 Y. US 10 Y. Like.
I'll okay. There we go. Thank you. And
my pleasure.
Oh, no. All right, I'll just do it this way. Yeah, and you can see they're strongly correlated. So if you're trying to trade this correlated to equities, it's not happening right now. So just be really careful with the dollar yen if that's the way you're trading it. And with that being said, I'm going to pass it over to my colleagues Steve and Stelios and Dale. And again, November 30th, guys, be here. Don't miss that interview. It's going to be amazing. We have jobless claims just came out, and I don't think it's never moving the market. So and you can see the dollar yen's not doing anything as a result. All right, guys, how's it going?
Very good.
Hey,
Hello.
man, good.
Good. You
Good
guys
hunting.
excited for that? You guys excited for that that interview?
Oh, yeah.
Absolutely.
Yeah.
Be a great
I
one.
don't think I don't think I'm
How,
going to sleep until then.
come on now. Stelios, you've been in this business for a long time, like
Yeah.
myself. When did you first see the $1 billion day?
Oh, years ago. I don't remember.
Most
over 10
people,
years ago.
most people that have been in the business,
about
like
the pound? Was that about the pound failing? And the Soros?
no. That's
Okay.
Rogue Trader, Rogue Trader, the movie. But that you should see too, because that's really good. No, $1 billion day. They were trading yen against each other, and it was like a 30-minute BBC video. You guys should watch it. It's good. So I put it in the chat box for
All right,
everybody.
thanks, Mike.
I can tell you that Stelios had a friend that made in 2009 $1 billion for the bank on his own. So that was definitely not a 1 billion day, but a 1 billion year for his friend, right?
He had a good year for sure.
Yeah. So talk about the $1 billion day.
Yeah.
Crazy, huh? All right, guys.
And back then,
that's back in the 80s.
Because back in the 80s, $1 billion definitely had a lot more purchasing power.
Yes.
Yeah.
Anyway, you guys have a great one. Thanks everybody for listening in.
In my dreams, Steve, I remember how much buying power I had then with $1 billion.
What did you buy in 1985 in your dreams with 1 billion codes?
With $1 billion?
Amazon shares.
An island. My own island.
In Greece, I'm betting.
Huh?
I'm betting in
What would you
Greece.
buy, Steve? I know you love cars. You'd probably have a garage full of classic sports cars.
Yeah, I'm not so much into classic. I like modern. I mean,
All right.
it's like cars in a sense is like saying classic computers. It's nice to to remember how computers were, and it makes good stories with your friends, but they can't compete to what comes out now. So since I'm a speed junkie, like classic cars don't really satisfy my
You're wild. You're wild
yeah.
freak, buddy.
Indeed.
Speed racers, Steve Volge.
So going to the markets, but before we do so, Stel, what did we have overnight? Anything worth mentioning?
Very little, actually. We had the usual toing and froing between the Italians and the EU, where we're all aware of the situation where the Italians want to run a high budget deficit, but the EU people don't. It kind of makes sense. And we had Salvini saying this morning that the EU are underestimating the potential of a higher deficit its potential to turn around the economy. And this is debatable.
As the tax cuts of Trump would pay them for themselves, right?
Yeah, it's debatable. You can run a budget deficit in a good way, and you can run it in a bad way. And I kind of doubt that the Italians are going to, run a budget deficit to spend money to get the economy turning.
Unfortunately, I can't think of any country that during the past at least decade has been running a deficit for the good reason. I mean, for example, the US once became the empire it is because it actually borrowed money to build, to invest and build infrastructure. And then it became the country that it became, the country that was the biggest creditor in the world, the country that had by far the fastest growing economy, that it was a net exporter, etc., etc. And at some point, we started making up economics, in a very weird fashion, believing that really you can run indefinitely an economy based on 70-75% consumption, the vast majority of which is going to be based on credit, which of course is an experiment that's going to fail miserably. So yeah, you're right. I doubt that the Italians are going to be running deficits for any good reasons for building investment that will actually end up helping the economy grow.
Yeah, maybe I'm affected by the fact that I'm Greek and I've seen the Greek government do that. Maybe the Italians will prove us wrong, hopefully. But
are we talking about the country that had Berlusconi as prime minister for decades? Yeah, no.
They need Don Corleone to run the country.
Yeah.
You know
So
who
I
he
doubt
is?
it's Oh yeah,
Mm,
absolutely.
yeah.
Okay. Famous politician.
But apart from that, really, we had nothing. We had a few more headlines regarding Brexit, but really, we don't pay attention to them anymore. It's just toing and froing. So nothing really, I'm afraid, Steve, today.
Okay,
We're waiting
cool.
for the FOMC.
Yeah, we are. What does the market, you think, expects from that? I personally don't believe that they're going to be. I don't think they're going to budge because we had some, weakness in stocks. I don't think we should expect something dovish. I don't know what's your take on it.
Well, I think it's going to be very neutral. It's there's no reason for them to do anything else. Now, the thing is, what are we pricing for December? The Fed Fund futures are pricing 20 basis points. So that's 80% chance of a hike.
80% chance, yeah.
Yeah, which is, it's fair. If it was 100%, we'd be selling into that. If it's not. So I think that's pretty fair.
Yeah, I think it's fair as well. I think that unless the markets completely go unhinged by then, and they really like go on a very fast moving bear market. I think that they're going to hike in December as well. Yeah. So 80% sounds fair. I agree with you.
It would be a huge surprise if they don't hike, and central banks, they don't like to surprise the markets.
Yeah, that's true, and especially as long as the market will keep on pricing, such a high probability. It's one extra reason why they're going to do it, because they, as you said, they don't want a surprise.
They can hike and be very dovish, easily. But I think the hike is now done, unless something major happens.
Yeah, anyhow, for each hike that we get from this point on, we know that the chances for the next hike keep decreasing because, the Fed participants themselves have already indicated a neutral rate, which is not higher for sure than 3.5%, right, Stelio? So, for each hike that we get closer to that point, the less the chances that we're going to end up seeing the next one after that. So let's see what's going to happen from there. Okay, now, having to do with analysis, nothing really has changed here. Okay, I didn't want to go into much detail yesterday because Joe was supposed to speak about that on Bloomberg. By the way, if you haven't seen Joe's appearance on Bloomberg, you can find that either on our site or on our YouTube channel. Now,
Joe did a great job.
He did, although they messed up the chart.
Yeah, that's what I mean. He did a great job, even though they didn't show.
Did a great job because
you never would have known.
Exactly. If you didn't know about it, you would have never known. Yeah.
I'm not happy about them editing out his trademark stance at the end of the show, though. And I know Joe isn't either because he did it on purpose. So anyway, maybe next time.
So the plan that we had discussed about it with Joe, I have it here. Let me open it up because I have the screenshot actually from yesterday. Here it is. This is the plan we had discussed with Joe. As you can see, is that if somebody wants to, I discussed the possibility that even the most bullish case scenario might prove to be a fractal of the previous move lower that we had in January, at the end of January. And so far as you see, we've had a sharp move lower, right? So in my opinion, the most bullish case scenario remains something like a triangle or something like a consolidation for a period of time before moving higher, even if we assume that this is a correction, right? So the whole point here was, you can start shorting in this resistance zone that we were testing yesterday, which I did 1/3 of a position, then add more at this previous high, and then add more at the confluence of the 2870 resistance area and the 78.6. And this way you can build a position that's going to have, like, let's say, roughly a cost average at around 2830. And then, there are two options. One, you see a move lower from there. And, by judging what kind of a structure that move has, if for some reason, the move lower looks very slow and corrective in nature, and you believe that, this is going to be another leg higher and the market is actually going to shake off this drop like it never happened, which in my opinion is a low probability scenario, would give that scenario less than 25% to play out. I believe that the market is still going to give you the ability to exit at cost. Now, on the other hand, if we indeed get what we got here, I believe that we're at least going to get another sharp leg lower to at least retest or almost retest the previous lows, if not moving lower, perhaps to retest these lows, right, which are at 25.30. So, this was the plan Joe wanted to speak about yesterday. Unfortunately, since they showed the wrong chart, he could never speak about it. So, since he's not going to be on Bloomberg again for a few weeks, and it won't matter by then, I'm sharing this with you. So, this more or less, describes, how we're viewing the stock markets at the moment, because it doesn't really matter. I mean, you mentioned, Coach, earlier that the Dow Jones is overperforming. Why do you think this is the case, by the way, if you're still here with us, Coach?
Because people are moving into what they consider to be quality.
Exactly. So because we are seeing...
Like the FANGs were. Remember the FANGs? FANGs were the flight to safety trade 3 weeks ago.
Exactly.
Really funny, man. I can't forget that.
So what we're seeing here is that despite the market moving quite sharply higher, the underlying statistics show us that the market participants have started having some jitters. And how do we see that? Because we see a very, very, very clear rotation from momentum, from growth stocks to, as you said, a flight to safety, to value, right? And this is the reason why the Dow is overperforming at the moment. And I don't see any reason why that should change. So to be honest, if you're looking to be short, I told you what my plan is, but if you're looking to be short, that doesn't mean that has to be your plan, or doesn't mean that I'm going to be right. So far, during the past month, I've had 3 attempts to be short the S&P, and all of them happen to be successful. But that doesn't mean that the 4th one is going to be as well, right? If you're looking to be short something, I would really advise against choosing the Dow. You might prefer to be short the Nasdaq if you're looking to be short. You might prefer to be short the S&P. But in all honesty, I think that the worst choice is probably the Dow, for the reason we just talked about with Dale, and it's 100% like that. Okay. This is the plan. I've already had my first shot here. I almost got triggered with my second, third earlier today. I mean, yesterday and today at the earlier. But I'm still only 1/3 short. So let's see what's going to happen from here. There's no question about it. This recovery so far looks V-shaped, but keep in mind that even bear markets, I'm not implying this is a bear market. This has more chances of being a corrective move still, but I do believe that it's not over yet. But even if this is the beginning of a bear market, even bear markets have very sharp rallies. So personally, I don't really care, and I'm not really pushed away by the fact that we had a very strong day higher. Let me just remind you that very recently, and you can see it here in a comparative basis, let me mark, when we had this day here that I'm marking on the chart, I bet that almost nobody believed that, the next day we would do nothing, and the day after that we would get another sharp leg lower. And when I say nobody, I include myself. When I saw this kind of a candlestick, I thought that the market, I was convinced that the market is not done moving lower, but I thought that at least we're going to get some follow through by seeing something like this. So, a little pullback, a retest of this area, one more push higher, and then lower, right? So even by seeing this sharp move higher, I thought, okay, this is the first corrective move of the correction lower. It should have a little bit more higher to run, and then we're going to see the resumption lower. But actually, that was it. That one day higher, that was it. Now, in this case, of course, we have had more days, but I'm mentioning that because yesterday we had a very, very, very strong up day for stocks, and I'm pretty much betting that a lot of people are thinking, okay, this might have been like an ABC, the correction is over and we're moving straight to new highs from here. There is a chance, but in my opinion, as I said before, I expect at the very least a more complex correction. So I do think that there is a chance that this is the case, but I still think that this is, the lower chance, the higher chances that I expect at least an attempt to retest the lows before moving higher. And, this is the same way I view other indices. But as I said, I'm not going to be attempting to short the Dow because there is definitely a shift of the market towards those kind of stocks. Now, having to do with the DAX, nothing has really changed as long as we remain below the broken neckline at 11,850. We remain bearish. And now having to do with the FTSE, perhaps this is an ABC correction higher. Somebody can say, can't this be like a double bottom? Because, we did create like a double bottom. Yeah, but, you need to see a lot more upside to just because we got rejected from the previous low, that doesn't mean that it's already a double bottom, right? So I'm still monitoring this area as a resistance, the area above 72.50, before we can even start talking about the possibility of a move higher. And let me also show this because I showed it yesterday. This is the rebound from Nikkei. Nikkei actually tested yesterday the confluence, almost tested the confluence of this 50% fib and the ascending trend line and support as resistance. So quite an interesting level to watch here. We might turn lower from here. Now, having to do with the USD yen, as I've said, I find it really obnoxious. I thought that there is a decent chance that we're going to get rejected anywhere between 113 and 113.50. There is still a chance that we can get rejected from here. The move higher is not really inspiring, having to do with momentum. I mean, we had a strong move lower. The move higher is not inspiring. So I would still not rule out one more leg lower for the USD yen, but I'm not involved with that. I tried to get involved at some point when I saw that there is no follow through in accordance to what risk is doing. I just closed my position at flat, but with like a 0.04% profit or something like that, which in essence flat. And
Steve, I think that back under the 61.8 level, if we could start trading back under 40, that'd be just your first sign that perhaps this pop is terminating.
I agree, but as Blake showed before, and he's absolutely right about that. Now the question is the following: what happens with yields here? Okay, because if we go to the yield chart, first of all, let's have a look at the big picture. We were talking about this inverted head and shoulders formation long before it actually broke out. Okay, so this inverted head and shoulders formation in the yield chart, this is the yield chart, right? Not the treasuries themselves, the yield. They're inversely correlated, of course, but so far, this is the yield. So, we broke out of this inverted head and shoulders formation neckline. We retested it a couple of times. It held in both occasions as support. We moved higher. Now, this could have easily been another bull flag. We're now testing the previous high once again. We don't seem to have much momentum, but, there is no reason why not respect the possibility of another push higher, for example, towards the 161.8 of this move lower, which comes at 3.36. So, the yield is showing some momentum loss. You can clearly see it from the RSI. This is what we call like a reliable divergence because, the first print is above 70, and now this print, if this ends up being some kind of a high, is clearly below 70. So I would be a little bit careful here because there is the possibility that we might form a short-term double top. But, you have to respect the potential for more upside. Now, and even if you want to see the bonds themselves, as you see, we broke below a triangle, we pushed lower. This looks like another pennant, which is a continuation formation, which seems to be breaking lower as well. So, you have to respect this. This has been now a decently established trend. I mean, we've been moving lower since January 2016, and every single move we've had now it's almost 3 years, right? Because it's from the very beginning of 2016 and we're nearing the end of 2018. So during the past 3 years, every single move higher we've seen in the bonds, as you can see, this one is clearly corrective. I mean, now in retrospect, looking back, there's nobody that can doubt that this is a very clear pennant formation, right? I mean, this is the epitome of what you expect from a corrective move. So we had one sharp move lower, a pennant, another sharp move lower. This is a triangle. As expected, the triangle broke lower. Perhaps this is another pennant that we saw when I zoomed in, and perhaps this is breaking lower as well. I do see some momentum loss for the time being, so we might see some big rebound. But so far we need to keep respecting the downside. And as that's the case, you have to perhaps respect the potential of more upside in the USD yen. But as I said, momentum is waning. The USD yen itself, you can interpret this whole. I know that you're looking for a shorter term ascending wedge, coach, but even if you look at the bigger picture, this can be an ascending wedge itself, looking at the bigger picture. So perhaps the yen wants to trap people by pushing higher once again, perhaps towards this 116 area, and then move lower. So perhaps, but in any case, looking at the yen as well, this move higher is lacking the momentum you would expect in an impulse. For example, since we're speaking about USD yen itself, let's have a look at the history of USD yen, right? So this is USD yen. So do you see any of the characteristics that we had in this move? We had that low in 2011. I remember it very specifically. This is one of the worst trades I've ever had in my life, because I actually went long. I remember it like today. I actually went long almost at the lows. I don't remember the exact price. I have to go back to my trading account. But I actually bought the market literally perhaps like 50 pips above the low. And, once we saw the first impulsive move higher, I was like, oh my God, what an amazing move, what an amazing breakout. Like, you book your profits and, let's see what the market does. And then I didn't enter the market again once we were breaking above that. And then I was waiting again for another pullback, which never took place. So I lost then all that leg higher, although I had actually bought the low of the market. So anyhow, whatever. So you can see clearly how an impulsive market works. Sharp legs higher, corrective moves, sharp legs higher, corrective moves, sharp legs higher. And perhaps this whole move here could have been a triangle, so like the bigger correction of this huge impulse higher. But despite having broken above the triangle, we're not seeing this kind of impulsive moves that you expect if that was actually the end of a bigger correction and the beginning of another cycle higher for the USD yen. So personally, although I understand that shorting this market is a tough, game to play, on the other hand, I'm not being inspired that I should be buying this market, really. So, do what you want with it. Personally, I'm staying away at the moment. But if at some point I see like a big reversal, and definitely if I see the market for some reason beating the treasuries and seeing a big reversal there as well, I think that there is a good potential for at least one more leg lower to perhaps retest this trend line this time as support. Okay, so I know it's a tough trade, but I wouldn't be buying yet. And it is what it is. It's my personal opinion, and that's the only thing I can present. Now, one thing I want to get involved with actually, and I've already bought like a quarter of a position, but I'm very, very skeptical about it, is USD SEC. So I bought like earlier today, roughly where the market is currently, like 1/4. I sold actually 1/4 of a position USD SEC. I'm monitoring this parallel to this ascending trend line, and I'm monitoring this perhaps as a corrective move. And I would want to see one more leg lower towards 870, 874. But I want to see a daily close. I mean, yesterday we were looking like we would break below this trend line, and we pulled back. So yesterday was a no-go. So today I decided to actually, since the market is still heavy and it's still attempting to break lower, I decided to put my toes in the water a little bit, just by establishing a little bit of a position. And depends on how we close on the daily, I will increase that position to at least half a position and see how it goes from there. So USD SEC looks quite interesting to me. If we see more USD weakness. I know that other people are looking at USD NOK because USD NOK once again got rejected after getting very close to this. You can see that this is a large formation. It's definitely corrective. I would expect that this formation would eventually break to the upside, most likely because, as you see, we came in this formation from after a very impulsive move higher, but that doesn't mean that it has to happen now, right? And this is another rejection roughly from that area. So, perhaps there is the possibility and the opportunity for a deeper pullback. I like more USD SEK at the moment, so I decided to get involved with that. But, I wouldn't blame somebody if they wanted to be short USD NOK against the previous highs because, the risk reward is definitely appealing. You can be looking as a first target for a retest of the 820 horizontal support resistance area. Now, I'm not going to go over the USD CAD because nothing has changed here. I said it yesterday as well, and Blake said the same thing. This is the dead money. In what sense? I believe that eventually this thing is going to break higher, as I said about the USD NOK. So this is like a fractal of what we've been seeing with the USD NOK, but in a much, 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 much smaller scale. So I would eventually expect a break higher, but that doesn't mean that it has to happen now, right? So since it has made so many attempts during the past several days and all of them have been, a failure, the risk reward remains favorable for you to perhaps try to short it against, these previous highs, and perhaps we pull back more, or we pull back even, down to 128 again before we actually finally break higher. Regardless, there are better opportunities and better places to put your money on, unless we, at some point, any day now, we see like a very big candlestick finally pushing through and showing some volume and momentum behind it, in which case you can then feel confident that, okay, it just consolidated for a bit, but now it finally seems to be breaking out. So in this case, you should expect some follow through. But as long as it's just, oscillating and toying around with this resistance of this descending channel, I've already lost the vast majority of my interest for it until something different happens there. Another clear trade, and I said it the other day for me, is USD ruble. USD ruble, I think it's a textbook, perhaps at least an ABC. So I think, whenever we see a move lower, like some big day lower, I think it's going to be a nice short. And of course, a lot of people are looking into it. And yesterday, I actually bought almost at the lows. I bought 61.31. I got filled at 61.31, a quarter of a position long. So I dipped my toes in the water there in crude. So I already have a quarter of a position. Obviously, when we see a rebound in crude, something like this, for example, this might also be, we might see some kind of rebound like this before moving lower, for example. I think that would also be, a great timing for somebody to be looking for the USD ruble to break that triangle to the downside, right? Because ruble is very strongly correlated with crude. A rebound in crude should create a rebound in the ruble. A rebound in the ruble should push USD ruble to the downside, and those two can happen at the same time. So, you want to trade crude, you want to trade the USD ruble, you want to trade both of them. Anyhow, this is how I view the market. Let me see if we have any questions. Oh yeah, we have a question about Aussie Kiwi. About those of you that are subscribers in ForexAnalytix, you already know that I took 1/3 of my profits already when we pushed lower. So I've already taken profits on 1/3 of my position. I can't do that in the pattern in play, so the pattern in play is still active and in the money. But I've already retraced, both for my pattern in play and my personal position, my risk to break even. So now this is a free trade from this point on. And keep in mind that the Aussie Kiwi is currently backtesting a broken confluence of supports. So I wouldn't really be surprised if we get rejected from here once again. And see another leg lower. If I remember right, my target is here. I mean, the pattern in play target, because my personal target, since I like to scale in and scale out of positions, my personal target is lower. Actually, if we actually test this previous low, I might take off one more third of my position, but I would be keeping one more third in this occasion, because I wouldn't find it impossible. If I zoom out, you can see that there is a larger formation here, which is a symmetrical triangle. You can see it here. So I would like to hold one more third in case we actually go down and retest this confluence of the horizontal support area and the ascending symmetrical triangle support for the other third. So, okay, one thing at a time. Let's see if we get rejected from here and move lower. Anyhow, the pattern in play, as I said, is a free trade from this point on. Now, if you've actually followed that pattern in play, you can take any initiative you like to treat it as you do. Anyhow, patterns in play, as we've said, are indicative and educational. You are the master of, how are you saying it, Coach?
We're all captains of our own ship.
Of our own ship, exactly. And, we are here to teach you how we, as a group of traders that have actually, proved that we can trade for a living, trade, and hoping that some of the characteristics that make us successful, and I have to add to that, many of the characteristics that make us successful, many of the people that are in our chat room, because in our chat room we have really a very decent percentage of successful traders. Perhaps you see or find out or learn something from all of those people that makes you better to what you do, and that's what we're hoping for. We're hoping that you're gonna be there to become better, and but still take the initiatives for yourself, and then stay for the good company and for the several pairs of eyes that help you get hang of and be aware of more opportunities in the market. So thank you very much. I know you have a very interesting interview today with Peter. I'm gonna be here to listen in, and we'll be back tomorrow as usually. Enjoy the interview.
Steve. Thanks, Steve. And very true. Each of us only have two eyes. That's why I'm a big believer in having a community and having a mastermind. So hi, Peter. I'm going to make you a panelist. I understand that you're calling in, so I'm going to make sure you're unmuted.
I'll unmute him. Don't worry. Done.
Thanks. Hi.
Hi, Peter. How are you, buddy?
Hey. Morning.
Okay, everyone. I'd like you to welcome Peter Bookvar. Peter is a contributing editor on CNBC, and as soon as I show my charts, you can see this handsome, well-known economist, analyst, money manager. Peter, there's your site. So welcome back to Face, my friend.
Thanks for having me.
So Fed Day, what a coincidence. You're one of the better Fed watchers that I know, Peter, and I see that you're writing about it. A lot of people were probably hoping today that there might be a little softening by Powell, but he's on a mission and he doesn't care what happened to Amazon, the FANG stocks in October, does he?
I don't think so, but I also think that he's feeling a lot of pressure, in both sides. Well, I meant pressure from the data. Actually, I don't think that he's feeling pressure from a president who can say anything. I think he's feeling pressure in the sense that he knows, he acknowledges the equity market itself in October. He knows the housing market has slowed. The auto sector has peaked in 2015, but at the same time, the inflation pressures, I think, are building. Now, one thing that these Fed guys do is, yes, they focus on a lot of the data and their econometric models, but they do talk to, particularly the Fed presidents, a lot of business contacts. And if you just listen to third quarter earnings, almost every single conference call, you had a CEO talking about wanting to raise prices to deal with the price pressures they're dealing with, whether a goods producer dealing with higher transportation costs, or your restaurant dealing with higher wage costs. wage pressures and cost pressures are building, and I think they're hearing that. On the other hand, they pay attention to market-generated inflation expectations, but a lot of that is correlated to the price of oil. So 10-year inflation break-evens have fallen, but that's because oil has fallen.
Right.
But oil prices are still meaning pretty sticky here above $60. I think all in all, Powell realizes that 10 years into this expansion, and all the Fed has done is gotten the real rate back to zero. They're still extraordinarily accommodative based on that. At the same time, they're also double tightening. They're raising rates and they're shrinking their balance sheet.
Right.
And it's no coincidence that we've already begun to see market accidents this year, I think due in part to the reduced liquidity that we're getting from the Bank of Japan, the ECB, the Fed combined.
And why do you think that emerging markets and other markets are suffering more than the U.S. when we're actually the driver of what put pressure on them? And also, Peter, you bring up what was talked about on a lot of earnings call. A strong dollar was also a complaint of a lot of CEOs. So,
no question.
Do you thinking about continued dollar strength being a problem?
I mean, I think it will be, but I'm not confident that we're going to continue to see a rising dollar. So I don't think it necessarily gets any worse from here, at least on the dollar side. When emerging markets,
how about the tariffs on price pressure?
Well, yeah, that's part of the price pressures we've heard throughout the third quarter conference calls is talking about tariff pressures, whether you're a user of steel and aluminum or you're caught up in other products that have already been slapped by tariffs, knowing also that there's the potential that the rate of 10% can go to 25% in less than 2 months.
Okay, so I'm looking at the 10-year chart, the yield chart right here, Peter, and we have kind of a little double top at 323, 325. Where do you think we're headed here? And could there be a pullback? There really was no flight to quality in October, zero. I mean, have you ever seen that kind of market sell off without any flow into treasuries?
Well, it's been a while, and I think that was a noteworthy characteristic of market activity in October was both assets went down, and I think that's a precursor certainly of what's to come next year. I remain most worried about what happens to European bonds when the ECB is fully done their QE outside of reinvestments, and what that also can do to an upward drift in U.S. Treasury. So I'm looking for a 10-year yield next year of 3.5 to 3.75, and not for the good reason of the economy's great, let's see higher yields, but inflation pressures and other outside pressures, like I mentioned, Europe and Japan letting interest rates rise, and the huge amount of Treasury supply that I think impacting the Treasury market in terms of foreign participation. We've seen Treasury auction after Treasury auction that's been pretty poor, I think reflecting very modest demand. So a combination of these factors, I think, will continue to have interest rates drift higher in the longer end.
Okay, I wanted to ask you, and then my associate Steve has a question for you, Peter. A lot of people are using the market analogy of, say, 1937, where we were coming out of the Depression and the Fed began to tighten, which drove us back into a double dip before World War II. Do you see the possible danger of that happening just because of data and that the economy isn't as strong as some of the numbers are saying, and that we can't take as much interest rate pressure? Like you said, we're not even back to neutral, and there's already market rumblings because they're so used to free money.
Well, yes, and that's the case with almost every single rate hike cycle, as almost every single rate hike cycle ends up putting the economy in recession, and the ratio is about 80%. So yeah, every time you get into the situation, you have to assume that a soft landing is a rare occurrence and is unlikely to happen again, especially when you are tightening from a base that was so extraordinarily easy, where markets got inflated and the economy got addicted to that very low rate of interest, that the rate of change
withdrawals are a bitch.
Yes.
Okay. All right. So as we go through this withdrawal, I'm going to let Steve come in here, and he has something he'd like to ask you, Peter. Go ahead, buddy.
Hello, Mr. Bukvar. I've actually spoken myself, during the past few weeks about the slowing of the housing market and what the auto industry is also showing. I actually forgot to mention today that we had mortgage applications at 18-year lows, and we're seeing the stockpile of unsold housing inventory increasing to 7-8 months, which is a high for a multi-year high. Do you really think that these indications can reverse and not end up showing us that these are the first signs of a recession? Do you really think that the U.S. economy can make it out of avoiding a recession, especially as you very well said, after a 10-year expansionary cycle? This is the first question. And the second question is, during the next recession, whenever that is, personally, I believe it's going to be rather soon. What do you think the chances of a stagflationary environment are? Meaning, what are the chances that this time we're going to have a loss of faith in the dollar, which will take us back to what we haven't seen since the 70s? Thank you very much. Those were my questions.
Well, the first one I think is very difficult to reverse. I think when you've had, at least over the last 20 years, monetary policy being so dominant of an influence on both markets and the economy, you've created basically credit cycles, and that has replaced normal economic cycles driven by savings and underinvestment that leads to overinvestment, leads to underinvestment in inventories up and down, and credit cycles now have dominated, and therefore we remain beholden to the ebbs and flows of monetary policy, changes in interest rates, and the fluctuations of liquidity and money supply growth. So as the Fed is now tightening, it's tough to then reverse the other end of the credit cycle, particularly housing and autos that are so highly sensitive to it for obvious reasons. So I do think that they will carry this towards a point where it does tip us over into recession. I think a lot of that will depend on the rise in interest rates and to what extent it goes from here and how that affects the equity market. If you look at the last two recessions, it was driven by declines in asset prices. A collapse in tech stocks led to a collapse in capital spending. And then obviously the fall in home prices led to a collapse in bank balance sheets. And we know what happened after that. This time around, the epic bubble really took place in global bond markets, particularly when you look at negative interest rates. I mean, that's the epitome of a bubble, that when you get this reversal in rates and monetary policy, and you get eventually a repricing in all the assets that are priced off the cost of money, that will then lead to, in my opinion, next recession. Because when you look at the U.S. economy, with global trade slowing down, with housing and auto slowing down, the U.S. consumer and even capital spending slowing down in response to reluctance to take big bets ahead of the uncertainty with the tariffs, it's the U.S. consumer that's really keeping things afloat. Labor market's pretty solid. Wage growth, I think, is picking up steam. So what would offset that picture for the consumer? And that would be a decline in the equity market, particularly since a large portion of retail spending is done by the people that own stocks that would be affected by a decline in the equity market. To your second question on stagflation, I mean, I think we could potentially see like a stagflationary light type event where the inflation pressures that talked about earlier continue to pick up steam, and at the same time it slows growth. I mean, when you think about it, makes perfect sense because higher inflation is a suppressant on growth. The higher my cost of living, the less inclined I am to spend, and it would then obviously make sense to slow growth. And particularly when you deflate nominal GDP to real GDP, the higher inflation is, the lower your growth is. So if inflation does continue to creep higher for reasons that I stated, that will inherently lead to a stagflationary type environment because higher inflation always leads to lower growth.
Okay, Peter, thank you for answering Steve's question. Some inflation pressures could probably be relieved, Peter, if we ate flat screens and lived in a tent.
Yes.
What do you think?
Technology is a general suppressant on prices, just as we progress as a society, and you're able to produce more with less and make it up in volume. Most of the inflation has been on the service side over the last bunch of years because that is much harder to make more efficient, and plus, with housing and education and the government's involvement has helped to inflate prices there. Now we're seeing a pickup in goods prices because of the tariffs and higher transportation costs and potentially higher wage costs, which also feed into obviously the services inflation. So I think there's always a natural suppressant on inflation, but now I think we're in the cusp of a cyclical rise in inflation.
Also, I remember certain periods, Peter, it's very difficult to control commodity price inflation. The Fed can't print soybeans and corn and wheat. And if food prices enter a bull market, very difficult for the Fed to control that.
Agreed. And that's why it's hard for them not only to control it, but they also somewhat feed it, because if they don't attack it with it is very difficult because the laws of supply and demand are much outside their purview, particularly when you're dealing with commodities that have global influences like crude oil, for example, and agriculture, as you said.
Right. A lot of people are making a case that I know you believe the sovereign debt's an issue, but do you also feel that corporate debt, which has been on a binge for a long time, and that money was not used for new plants, equipment, raises, but for financial engineering in their own stocks and dividends, that's going to be an exacerbating influence when the stock market rolls over? Isn't it almost like they're going out to borrow money for stock buybacks, makes it a margin account?
Well, yeah, but it also also, you have to look at the other side too on cash flows, and that yes, if you have this inflated balance sheet, it's fine if you can service the debt, but if you are about to enter into a rising interest rate environment, which we are, particularly LIBOR, with a lot of corporate debt LIBOR based, particularly for smaller companies where a lot of borrowing is floating rate, the rising cost of capital costs more to service it, and at the same time, if the U.S. economy is going to slow next year for reasons stated, then you potentially can get into a cash issue. So it is something that we have to focus on. That's where a lot of the bubble. So when I talked about sovereign debt, it was a credit bubble broadly in sovereign and in corporates. And look at the triple B, or the investment grade universe, where half the credits are triple B versus about a quarter of that more than 10 years ago. So that is going to be a focus. And if you're going to own stock in a company that has an inflated balance sheet, you better make sure that it's at least termed out and it's a defensive business that can finance something that comes, whatever comes their way. If it's a cyclical business that's highly levered, I'd be very much suspect of that company.
Okay, so where do people go? Is cash still the right way to go in this environment? What are you telling people that you advise in this environment to focus on the return of capital rather than the return on capital?
Yeah, I mean, 2-year notes are pretty attractive, yielding almost 3%. Still remain bullish on precious metals, and I do think that there's opportunities being created in overseas markets. I actually think that emerging market debt in local currency has become attractive, with yields about 7% on a blended basis. As I do think that the worst of their currency declines is pretty much over, and that would benefit from any particular weakness if the Fed blinked next year. So, and even some of the beaten up markets in Asia, equity markets, I think are attractive with anybody with a time horizon more than a couple of years, because that's where the growth is going to be, emerging Asia over the next 10 years. I grant that China's got a lot of challenges right now, swamped by debt, particularly in the banking system. So it's not going to be an easy road for the next couple of years. But I think looking past that, I think that region is a very attractive place to be investing.
Okay, so if we agree that there's going to be a turn down in the dollar, whether there's one more push up or it ended a week or so ago, you're going to get your biggest bang for the buck in emerging markets and emerging market bonds.
Yes.
Okay, so it's interesting because Steve was showing the emerging market. Is it possible that they begin, once the dollar turns down, everyone feels safe and almost have hubris that the U.S. is the only place to be, that emerging markets can make up for their deficit and actually begin to outperform the U.S. in that scenario?
It'll outperform. Now, obviously, if the U.S. economy runs into trouble, emerging markets are certainly going to get affected. I just argue that their markets have already repriced to a large extent, and while they still may go down, they'll outperform U.S. markets.
And your view on gold, you like the miners as well, with your constructive view on the bullion?
I do. I mean, I think miners over the last couple of years have gotten religion and understood that they need to right-size their balance sheets, focus on cash flow and profitability, and less on growth for growth's sake. I mean, we have, I believe, reached a trough in the cycle, and the economics of the mining business, which are terrible to begin with, I don't think will get any worse. And all they need is a little relief from the actual pricing, and I think that there's a lot of leverage in these business models right now to an upside rise in precious metal prices.
So you really have to do your due diligence on their balance sheets when they're under production costs. The metal is under or at production costs, right?
Yeah, I mean, I understand that mining is a crappy business, and geographically, you're in places you don't necessarily want to be in. For those that travel outside of mines in developed countries, and your costs are all over the place a lot of times with a heavy reliance on labor. And then when the price of your product is trading on a daily basis, it makes long-term planning very difficult. So always a challenging business, but if you can make money at the trough of a cycle, if you can generate cash flow at the trough of the cycle, you can only imagine what can be done when that cycle actually turns to the upside. And speaking of this, I also happen to like the uranium market, which to me is becoming much more interesting because the cuts in production from Kazakhstan, Cameco, are beginning to have an impact, and spot pricing is up about 40% this year. And if that can be sustained, I think that the uranium market could be very interesting in the next couple of years.
And it's I mean, the gold and silver miners are not a lot of market cap. Uranium stocks are only a fraction of gold and silver mining stocks. So it wouldn't take a lot of money to move those issues, would it?
Right. I agree.
Okay. So I've never asked you about this before, Peter. And I want to know, what do you think about the crypto market, Bitcoin? When people ask you, what do you tell them?
I mean, as a bull on gold, I get it. I get the creation of it and wanting to have an alternative currency and outside the financial system, and I understand all that, and certainly blockchain. I just don't know how to value that. Bitcoin can go to $5, and Bitcoin will still be around, and blockchain will still be around, and Bitcoin can still be serve a useful purpose. I just don't know what price it should be at. I think if tomorrow Bitcoin was $5 or $50,000, I don't think anybody would be surprised. So I agree that they're probably here to stay. I just don't know what any of these coins should be worth on a daily basis.
Okay. So it's okay, better to admit you don't know and stay away. So as far as any kind of investment in that arena, that's a no touch for you.
Yes. Exactly.
Okay. So Peter, I want to thank you so much for being with us today. And, I know that you have a little more company now with your outlook, because a lot of things that you and I have talked about over the last year or so are starting to manifest on our screen. So congratulations for not losing your conviction.
Thank you very much. I appreciate the opportunity to have this interview.
And I advise people to take a look at Peter's website. Is it www.thebookreport.com? Peter?
Yes.
Okay. Is that the web address for the book?
Yeah, that's the web address for my daily pieces, and
Right.
the wealth management firm that I'm the CIO at is bleakley.com. And
Okay.
people that are interested in wealth management services can always reach out.
Okay, so CNBC contributor, I did it twice, Peter.
Yes,
Peter
thank you.
Peter Bookvar with us today. Peter, I wish you and your family a great holiday season.
Thank you as well.
And $100 bills fall down on you like snowflakes.
Yes, thank you to you and
All
your
right,
guests
buddy.
as well.
All right,
thank
thank
you
you so much, Peter. Okay,
bye-bye.
everyone, that's a wrap. Thank you, investing.com, for watching. And we'll be back to wrap it up, TGIF. Don't forget to subscribe. And don't forget to look for a better place to trade through Trent and Justin. And most of all, don't forget, don't just count your pips, count your blessings. See everyone tomorrow. Adios. Good hunting. You're welcome. You're very welcome.